Well, Mike, I'll focus on a handful of places where we spend our time and maybe start the discussion with where do we not see the opportunity, or simply put, it's where everybody thinks a credit manager does, it's just long only. And that's not the opportunity. I mean, the average yield in the US is high fives, the average in Europe is mid threes. I mean, it was mentioned in a previous panel, price to perfection. It's always been an equity term, but in credit, there is so many things that can go wrong. You don't even have enough coupon to protect you anymore against these big, horrible events that could occur. We talked about liquidity drying, bonds tend to gap in 10-point increments, so it's not as a long-only investor. So how do you stack the deck in your favor and look at other opportunities? We talked about middle market lending. We have a good slide number 2. And why is middle market lending a good opportunity? Well, small companies present some great risk-reward opportunities, but it's really about technicals. Pre-crisis, this stat here starts in 2002, 69% of middle market loans was just what you'd think it is. It's a bank business. Banks lend money to small companies. Today, as most recently measured, first half of 14, it's 12%. That's a $50 billion annual gap. And if you look on the right side of the page, the maturity wall, I mean, there actually is a maturity wall. So it's literally the opposite of what you have in the big liquid market. Lots of demand, a little bit of supply. In the liquid market, here's lots of supply, little bit of demand, creates a different balance. And one of the places that manifests itself, to continue the discussion we were having, is covenants. So I always kid that I think the word covenant light was invented by some marketing firm, because really covenant light means no covenants. And 2/3 of the bank loan market is no covenants. And as a result, what do you have as a lender? We seem to have selective amnesia of what it's like when the default cycle comes. I agree 100% with Steve's comment about where we're headed. And without covenants, you literally don't have anything. So specifically when you're in the illiquid asset classes like direct lending, if you don't have covenants, you don't have anything. And it gives us the ability to create bespoke covenants. A second opportunity, we showed the slide, it's one we use, as page 4, is commercial real estate. We'll come back to that, commercial real estate debt. This looks like what the middle market lending slide probably looked like if I was on this panel 7 years ago. I find this actually funny. It's almost like cocktail party conversation. Look in 2007, the top 15 lenders with all the red X's through them, and look at the market today. And for the first time ever, there's Cantor Real Estate, there's Ladder Financial.
For someone that can't read it, what does the red X's stand for?
So 2007, that is the league table of the top 15 CMBS commercial real estate lenders. The red lines, I can't read them either from here, but the red lines are the firms that no longer exist.
Well, I think that was the point I wanted to emphasize for everyone.
Again, this is a market setting up lots of supply, limited demand, ability to, control your terms. Again, the opposite of the liquid market.
Just really quick.
Last one I'll mention, I think running a strategy where you have a short side, the ability to go the other way in the market, is something that we focus on through our hedge fund. But lastly, and maybe this is a topic that will get others in the group going, is the opportunity in Europe. So as you saw in some of these slides, there is, again, maybe 7 years ago in the US, maybe this is what the US looked more resembled, where you have a market that's largely dominating in the lending space by banks. And it seems to us, both pulling assets off banks, lending directly to companies or sponsor deals, there seems like a big opportunity to create really good supply in a market where the banks are only going to shrink.